Hey, big bulls, buckle up because Bullseye is here.
We are going to serve you juicy and fresh updates on all things that's happening in the markets. We're going to bring 3 interesting stories, but wait, we are not going to just skim the headlines, but actually dive deep into what really matters and why.
But none of this is really investment advice, right, Saloni?
No, it's not.
All right, so what do we have for our very first edition?
So we are going to talk about Swiggy's big bang entry into the stock markets. We're also going to cover this small cap stock that's rallied around 67 lakh% in just one day. And then we're going to talk about all these ups and downs that's happening in the stock markets.
All right, so Saloni, we'll start with the Swiggy IPO, right? That's the big thing that's opened on the 6th of November. Now think about it, right? When does a company usually go for an IPO? They IPO when their business performance is good, right? Their numbers are fantastic. People are excited about the company. Or they IPO when the stock markets are booming, right? And there's this entire wave in the stock market that's going to lift all the boats in the ocean, right? So these are the 2 reasons why, or 2 scenarios where a company typically IPOs, right? But the markets for Swiggy are not looking good. We said we'll talk about it, but they're not looking good, right?
So what about the numbers of Swiggy?
So the numbers are where it gets a little bit more interesting. Because let's compare Swiggy with Zomato, right? That's its closest competitor. I'm going to pull out the numbers over here because Swiggy is losing market share. And let's be honest about it. In food delivery, Swiggy used to have a market share of 60% in 2018, and that has dwindled to just 42% now. And if you look at quick commerce, the one where they pick up groceries and they deliver, same fate here. The market share has dropped from 52% to 32% in the same period. And on the other hand, Zomato is lapping all this up. Zomato now has 1.5 times more monthly users than Swiggy. Zomato offers fewer discounts than Swiggy, and still people are flocking to Zomato. And Zomato is also showing a profit on its books, while Swiggy cannot do that.
So, because both of them are food delivery platforms, right? What exactly is not working for Swiggy?
Well, it's hard to actually put a finger to it, but some research papers and media outlets say that some business decisions at Swiggy didn't quite pan out the way they expected. And the simplest example is actually the usage of their delivery fleet. So apparently Swiggy decided to have a shared delivery fleet between their food delivery and their groceries. And the most obvious problem with that is if you actually are a user of these Instamart and Blinkit and all of it, and you do a comparison, you'll see that Swiggy's delivery times are far longer than others, right? So that's the problem. Blinkit also, on the other hand, what they've done is they've effectively been able to get higher value products on their platform. So the average order value is a key component over here. And Blinkit actually has a 30% higher AOV than Swiggy's Instamart.
So what exactly is an average order value?
All right. So think about it this way, right? So let's say Swiggy Instamart, they are delivering an order by spending 10 rupees for the delivery and all of it. And they're able to charge 12 rupees from the customer. Now that's a positive aspect. Now, imagine if Swiggy can actually sell more higher value products in the same order, right? And that order value, instead of being, let's say, for 100 rupees, it goes up to 1,000 rupees. Now, Swiggy is able to get more out of it, but the delivery costs remain the same, right? So it's more bang for the buck for Swiggy that way, which Blinkit has been able to do.
So talking about a takeaway, right? After whatever you've mentioned, who in their right mind would actually invest in Swiggy now?
Well, that's interesting. So let me try and put it in 3 ways, right? Let's look at it 3 very different ways. Let's assume, Saloni, that you're already an investor in Zomato, right? You know that everyone's lapping up this food delivery and grocery space. All of us are using it, so you know there's demand out there. But you're also thinking, what if Zomato kind of slips up, right? Simplistic, and they get cancelled, right? And the simplest example is, remember when a few months ago, they launched that green delivery thing for veg orders, and everyone went berserk. Right? So what if something like that happens and people decide to boycott Zomato, right? You believe in the industry, but you also want to hedge your bet. Mm-hmm. That hedged bet is Swiggy, right? So that could be one way of looking at it. The other way of looking at it is actually in terms of the valuation, right? Yes, Swiggy is a secondary player, but are they actually offering their shares at a discount in this market? And if you look at the numbers again, Swiggy is asking only for a multiple for the IPO of 8.5 times its financial year 24's revenue. On the other hand, Zomato is already trading at 18.5 times its FY24 revenue. So there's a big difference over here. And relatively, Swiggy looks like a bargain buy, right? Yeah. And the third one is you actually truly believe in Swiggy. You've seen them execute in the past. You've seen that they have the chops to do it. They've seen their innovation across different products. I mean, like Swiggy was a pioneer once. They can do it again, right? So that is a belief that you go in with, and you're like, it's just a matter of time for Swiggy to come back and rule the game again.
Also, because you're from Bangalore, maybe you want to cheer for the home team.
Maybe Bangaloreans might do that. Who knows? Let's now talk about the next item, Saloni, which is this Elcid phenomenon, right? It's you said a 67 lakh % jump in a day. I can't even fathom that. So it's now become India's most pricey stock after MRF, right? So what's going on here?
Like how often do you read about a stock that's gone from just around rupees 3 per share to nearly 3 lakh per share, that too overnight, right? And that's happened. So we are talking about Elcid Investments, which was a little known small cap stock, right? And kind of rallied significantly. And obviously everyone's been talking about it. But this dramatic surge actually happened after a special session was conducted by the stock exchange, that is BSE and NSE, as per the new SEBI rule.
Okay, so what's this new SEBI rule that's triggered this?
Okay, so before that, just to give a context, right? So in India, investment holding companies such as Tata Sons, they do not have any business operations, right? They're the ones who invest in other companies, right? And so they do not earn revenue as such.
Yeah.
So they are only the ones who are earning money from, getting dividends from their investments and, managing those assets, right? So, but many of these stocks have been trading around 60 to 70% at steep discount. And they have been very illiquid in nature. And that is one of the reasons why investors have not been interested in buying these stocks. And that is one of the reasons why this trading volume has also been not that high, right? So to ensure this fair pricing, SEBI asked exchanges to hold this special session where they will discover the prices of these stocks which are actually trading at significant discount from their book value. Now, book value matters for investment holding companies is because that actually signifies the portfolio or how much they're worth. Right? So that is why looking at their book value matters more than looking at the stock price. So now to ensure that fair balance between that, that's when on October 28th, we saw BSE and NSE conducting this session. And Elcid's book value around that time was rupees 5.85 lakh. So clearly it was undervalued, right? But then with the special session, boom, we saw this historic price.
So you did mention there are other companies in this space as well, right? Going through the same thing. Can you name any, like what's going on with them?
So yeah, again, it wasn't the only stock that saw this price adjustment, right? There are other stocks such as Kalyani Investments and Bombay Burma, which also are investment holding companies. And they also did see significantly increase in their stock price. But again, not like Elcid. So before you ask why, let me tell you, Elcid had barely traded in the last 5 years. It just moved around rupees 2 and rupees 17 during the last 5 years. Whereas these other stocks that I named, they had certain fluctuations in between, right? So because of the flat movement, when the new special discovery mechanism kicked off, they picked it off, and then we saw this sudden, huge boom in the stock price.
That's very interesting, Saloni. But I have one question over here. You did say that Elcid is a holding company, right? Like Tata Sons and others. Now, I want to ask you, so what does Elcid actually have in its portfolio? What have they invested in? What have they done?
Right. So Elcid also invests in shares, debentures and mutual funds. And it actually invests via its two subsidiaries. One is Murahar and another one is Taswar Investments. So as I said, they earn dividends from these investments that they make. Interesting thing here is that Elcid has an investment only in Asian Paints, where it holds around 2%. Right? So that is why experts think that Elcid's recent market capitalization, which is around 5,000 crore, is still not capturing the whole worth of its portfolio. Because if you calculate the 2% of Asian Paints as well, it actually will be more than 5,000 crore, the value that they hold there, right? So they actually see this rising more further. But beware, as I said, holding investment stocks like Elcid are very illiquid. They're very risky. And they have also always been seen as something that does not have growth potential, as they do not have any business operations. They only make money out of this dividends, right? So that is why we saw this spike of a rare event.
Right. But remember, this is not again investment advice. Okay, I mean, we have to keep putting that disclaimer out there, right? So, all right, cool. So we have Elcid, and now let's talk about this weird market, Saloni. This market rise, the market fall, and this market rise again. What's really going on?
So aren't we also used to seeing our portfolios in green, at least from the last few years?
Yeah, the red does feel bad.
Yeah, it does feel bad, right? Of course, thanks to the bull market that we saw.
Yeah.
October was a reality check for all of us. And now the start of November has been kind of carrying forward that red, as you mentioned, right? So it obviously isn't exactly fun. When we talk about our benchmark indices like Sensex and Nifty, they actually had their worst month in October in over 4 years.
Yeah.
And while the dip does provide you an opportunity to rebuild your portfolio, it does make you wonder, why the markets have been so moody lately.
Yeah. I think over here also we have like 3 reasons, right? Primarily. And at the end of the day, we have to remember that the stock market is a function of what companies actually earn, right? The earnings, the profits, whatever you want to call it for the companies. And that's not looking too good, right? The September quarter results are coming in weaker than people have expected, right? Many companies are actually reporting zero growth. And out of the 34 companies, Nifty companies that have reported, earnings have been flat. So they're missing all these analyst expectations as well, right? And that's the worst thing to happen when you miss an analyst expectation. So brokers are downgrading earning predictions, and that's kind of dragging down the market sentiment a little bit, I think. And, there is a slowdown in the economy as well that's happening. So there is something that's, hanging over like a dark cloud over the stock markets, right? But I think there's more to what's happening externally as well, right?
I think there's one more thing that's all that's happening in the United States, right?
Yeah.
First, obviously, you have the US elections where there's this, very tight race between Kamala Harris and Donald Trump. And because of this uncertainty, obviously, investors kind of want to be wary of what happens next, right? But after that is also the Federal Reserve meeting outcome that happens this week as well. And even though we know that Fed is going to cut rates, the quantum of it is something that's not known. And that's again, and also the clear indication of where the Fed sees the interest rate journey to happen, right? And that's what we will get to know this week.
Right.
So I think once we have a better clarity of that, maybe investors will know. But I think right now, because of that, they are being very cautious.
That's fair. And I think they're also foreign portfolio investors, which make up a decent chunk of our market. They're also kind of in an exit mode right now, right? Part of it could be due to the US elections where they're moving to safer haven assets, but also because of what's happening in China with the Chinese government and the Politburo, they're trying to prop up their stock market and their economy. Foreign investors might be thinking that from a relative value perspective, China might be offering better opportunities than India right now, right? And a lot of them are definitely moving there because of the high valuations in India. The one thing that is, I guess, propping up the Indian markets though, are people like you and me and, everyone else who's watching, the domestic investors, where the SIP book is insane over the last 5 years, the growth of the book, right? So then that's keeping the market, I guess, intact.
But, as you mentioned, valuations as well, like do these stock valuations even matter?
Well, let me not give you the answer. Economic Times asked Rajiv Thakkar this question. Rajiv Thakkar is the chief investment officer of PPFA's mutual fund, a really popular mutual fund these days. And he gave an answer that I think I'm now going to use for a very, very long time, right? And he said, and I'm going to quote this, right? This is Rajiv Thakkar, and I'm quoting this. So my favorite example is things like Infosys and Wipro. If you bought them in early 2000s, let us say in Jan 2000, in a decade, Infosys probably increased its profits from 250 crores to 6,500 crores. But the stock barely gave national savings certificate returns over 10 years. So if starting valuations are very, very high, then it becomes difficult to generate returns.
So basically valuations matter there.
That's what he says. And it looks like he's walking the talk too. If you actually look at the industry, equity mutual funds, their overall AUM, 5% of their AUM is in cash right now. But if you actually look at PPFAS, their flagship fund, a whopping 15% of their AUM is in cash right now.
So cash is king, I guess. That's something.
Well, that's definitely something, Saloni. And with that, it's a wrap on our first edition of Bullseye. I hope you have enjoyed this. Bear with us because it's the first time that we are attempting something like this. So do let us know any feedback that you have. Leave it in the comments.
And see you next week.
Bye-bye.